Hello, my name is Robin Choi. I'm the APAC Gold Strategist at State Street Global Advisors. So today I'm going to talk about gold investment and why gold in general. From our perspective, gold is a unique asset class because it has drivers that are unrelated and are both cyclical and non-cyclical drivers. If we look at the annual demand of gold, it's driven by jewelry, technology, investment, and central banks. Jewelry sector and the technology sector are both cyclical driver, which means that during a positive economic cycle, there'll be more demand to drive up gold prices. And over the past 10 years, that represents about 60% of global demand. It's a counter-cyclical driver, which means that during a negative business downturn, we expect more demand through investment to drive up gold prices. In the last 10 years, investment represents close to about 30% of global demand. And lastly, we have the central banks. Central banks is non-cyclical, which means that during a positive and negative business cycle, central banks will buy gold to diversify the FX currency reserves. In the last 10 years, central banks represent about 15% of global demand. And if we look at all these drivers, it plays a very important role for gold to have these low correlations with other asset classes like stocks and bonds. From our perspective, gold plays a very, very important role as a risk management tool, a tool that can provide capital appreciations and also wealth preservations. We believe gold is a very distinct, independent asset classes, and it should not be grouped into other classifications. When investors look at gold, they think gold is a commodity, which is true. Commodities like copper and oil have very similar properties to gold because gold and copper, for example, needs to be produced, and they have a very excellent hedge against inflation historically. But the key difference between commodities like copper and oil is that gold is not as cyclical as other commodities. So if we look at copper and oil, prices can do well during a positive economic cycle. But during a negative economic cycle, copper and oil can perform quite badly relative to gold. Gold is also considered as a precious metals. If we look at silver, palladium, and platinum, it has similar properties to gold because if you look at the physical properties or the chemical properties, it can be quite similar. And silver and gold historically has been used as a money, historically as a monetary system. But in fact, there are some key differences between gold and precious metals like silver and platinum. The main difference is that central banks do not buy silver, palladium, and platinum. Central banks around the world only consider gold as a currency, as part of their very important foreign currency reserves. Thirdly, investors think gold is a real asset, which is true as well. Real assets such as infrastructure and properties, it can be very similar to gold because they are both physical assets and both assets have potential advantages in hedging inflation expectations. But the key difference between gold and other real assets is that real assets is not as liquid as gold is one of the most liquid asset classes in the world. And also gold, it's very easy to invest in a way that you have ETFs in futures to track the gold prices. But for other real assets, sometimes very difficult to find contracts or financial instruments that can track those property prices. And lastly, gold is considered as a currency, which is true as well. If you look at USD and Japanese yen, for example, very similar to gold, it is a store of value. People hold gold in currency because they believe there's a value. And currency and gold, it's extremely liquid. And that's why people like holding gold in currency. But the key difference between gold and currency such as US dollar is that gold cannot be printed like a currency. gold needs to be mined by miners, and the supply is quite limited from a supply perspective. And that's the key difference between gold and currency, is that currency can be printed unlimitedly. Now let's look at the size and liquidity of the gold market. One interesting fact is that if you look at the chart on the left-hand side, you can see the amount of gold that has been mined and produced in the last 5,000 years. And you can see it's a very small cube. Basically, all the gold's been mined throughout the mankind history in the last 5,000 years. It's only 22 meters times 22 meters. It's extremely small, but it's extremely very valuable. So all the gold above Earth is close to around 220,000 tons of gold that's above the Earth. And if you look at the breakdown, it's mostly coming from the jewelry, the investment, the central banks, and also investment in bars and coins. But what most interestingly is that what's remained under the Earth. Under the Earth, it's only close to about 55,000 tons of gold left, which means that based on the annual production of gold, currently, after 16 years, all the gold will be mined throughout the world, unless there's new discovery. Hence, gold is very, very precious. It's very limited in supply compared to fiat currencies. On the right-hand side, you can see the market value and trading volume of gold. Gold is traded by many institutional clients and central banks around the world. It has an average trading volume of close to about 150 billion US dollars. And if you look at the breakdown, trading volume comes from the OTC market, mostly from London, the New York Exchange, through the futures, and also the ETFs around the world. Those three vehicles provide a trading platform for investors around the world to get exposure to the world gold prices. And lastly, for investors, we do think there's four main benefits for holding gold. From our perspective, we believe gold is a long-term strategic asset class which can provide very long-term returns to investors around the world. The number one reason why investors around the world, including central banks and global investors, they invest in gold because of the diversification benefits that gold can bring. As I mentioned before, because gold has very unique drivers coming from the jewelry, technology, investment, and central banks, it has very low correlations to other financial assets, including stocks and bonds. So during an economic downturn, gold can provide that hedge against your exposure to risky assets, including equities. That's the most important benefit of investing in gold, is the diversification benefits. Number two, the return profile is actually quite attractive for gold. If we look at the gold price in US dollar in the past 50 years, the compound average return is close to about 7.6% return. And that's a very decent return for an asset class that have very limited credit risk and also a safe haven asset class. So if you look at the past 10, 20, and 30 years of returns, gold have registered very positive return over those periods. And including gold can actually provide an investor an improvement in the risk-adjusted return for your portfolio. The number three reason why we encourage investors to look at gold is that the liquidity of gold is extremely high. Gold is actually one of the most traded asset classes in the world, and the trading volume is on par with some of the major indices, including bonds and stocks and currencies. With an average trading volume of about 150 billion or 60 billion a day, it's close to the trading volume as S&P 500 on a daily basis. And the trading volume of gold is actually loved and liked by global investors around the world, including central banks. And that's the key reason why global investors continue to like gold, because of the high liquidity it can offer. And lastly, with it, include all those points together, gold can have a very powerful impact to your portfolio. Because of its low correlations, the decent return profile and liquidity, when you include gold in your portfolio, it can actually improve the Sharpe ratio, which is the risk-adjusted return of your portfolio. It can actually reduce the volatility, actually reduce the maximum drawdown of your portfolio. So for investors holding a typical 60-40 portfolio, having exposure to global equities and global bonds, we encourage about 5% allocation to provide that strategic hedge against potential downturn in the equity and bond markets.
皆様こんにちは。ステートストリートグローバルアドバイザーズの稲と申します。これまでロビンが金の投資に関してご説明させていただきましたように、資産形成において金への投資というのは皆様の選択肢の一つになるかもしれません。現在 ETF を通じてオンライン証券様などの取引口座を通じて手軽に金への投資を実践していただけます。ステートストリートグローバルアドバイザーズは2004年に米国初となる金を裏付けとし、米ドル建て金価格に連動を目指す ETF スパイダーゴールドシェアーズティッカー GLD を上場いたしました。今年ちょうど上場してから20周年を迎える年となります。 GLD の残高は足元日本円で約10兆円規模にまで運用資産残高が拡大しております。また GLD は東京証券取引所にも上場しており、東証口座1326となりますが、米ドルおよび日本円でお取引いただけます。また2018年には低い経費率 0.10% の経費率で金への投資を実践していただけるスパイダーゴールドミニシェアーズティッカー GLDM を米国で上場いたしました。こちらは米ドルのみでのお取引となります。このようにステートストリートグローバルアドバイザーズは日本の投資家の皆様にゴールド ETF の投資においていくつかの選択肢をご提供させていただいております。取引時の流動性を重視される投資家の皆様には米ドルでお取引いただける米国上場の GLD を、また日本円でお取引いただく際には東京証券取引所上場の1326を選択肢としてご提供させていただいております。また1326は東京証券取引所が公表している NISA の成長投資枠対象銘柄に含まれています。資産形成においてコストを重視される投資家の皆様には経費率で 0.10% で米ドルでお取引いただける GLDM をご提供させていただいております。地政学リスクの高まり、インフレの高まりなど世界の金融市場は先行きが見えない不透明感の高い状況下にありますが、金価格は今年更新し魅力的な投資先として注目されています。ぜひステートストリートグローバルアドバイザーズのご提供させていただいているゴールド ETF を通じて金への投資を実践していただければと考えております。本日は最後までご清聴いただき誠にありがとうございました。